All right, this is the ETF Inspector, and this is actually the first time any of you guys have actually seen my face on a video. And I am joined here today with Mr. Michael Khouw from YieldMax or Title Financial Group. So, Mike, I just wanted to thank you for coming onto the channel and welcome you.
Well, thanks very much. I appreciate it.
All right, so I want to give a quick introduction here. I'm sure most people watching do know about you and who you are, but just wanted to, do this to get started. Michael Khouw brings over 25 years of experience in the financial markets and is widely recognized as one of the leading voices in options trading. He's the co-founder of openinterest.pro. He's also a long-standing contributor on CNBC's Fast Money and Options Action, and the co-author of The Options Edge, which I actually have a copy on the way to me now. I won it on a Spaces talk where I got to ask you a question recently. There was no bias there. I don't think you knew I was setting this up when that happened. But most recently, he was the lead panelist at the Robinhood Summit last week, where we were able to see his love for helping to bring understanding to the trading community. Mike is a former partner at Cantor Fitzgerald, managing director at CRT Capital Group, and a member of the Philadelphia Stock Exchange, the American Stock Exchange, and the New York Mercantile Exchange. So, Mike, thank you for joining us. That's a
Thanks for having me.
pretty nice intro you got there. So I want to start off a little bit lighter before we go digging deep. So you've been in your new position now for about a month. I'm just kind of curious how you settling in. You getting used to the changes. You liking what you've got going on?
I do like it. I like these guys. I like what they're doing. I'm a fan of the ETF wrapper. I actually wanted to launch an options-based ETF several years ago. It was slated to launch during 2020, and then we had the COVID-related shutdown, and it delayed some things and created some problems. But there were some changes in the ETF space that made this kind of thing possible in recent years. I'm referring to 18F-4, and ETFs are a great wrapper. It gives investors a lot of flexibility, and now increasingly it's giving managers flexibility because they permit certain structures using options that they didn't previously. And there's a lot more actively managed ETFs. And I'm not just talking about options ones. I'm just saying in general, I think most people used to think of ETFs as just a proxy for an index, really, and other passive strategies. But there's been a lot of innovation recently, and it seemed like a good time to get involved.
Sure, yeah, that's a good point. I have a lot of my viewers comment sometimes that they are interested in options trading, but they haven't tried it yet. So this is an opportunity for them to have access to some of the benefits from that without maybe getting burned the way a lot of us did when we started options trading on our own. Maybe not you, but me for sure. Um, so is it difficult? My next question is it difficult kind of switching over? Not that you're done with your former life, but from network television to YouTube type interviews. Now I know I see some of your interviews, and a lot of times it's remote like this. It's not like you're live in studio all the time, but there's still probably a lot more stress that comes from the producers as opposed to this. Um, is it a difficult transition?
I, you know, I really enjoy this, I have to say, and one of the reasons is because network business news is really not a really very flexible format, and you don't get an opportunity to delve into issues very deeply, and there's no real-time interaction. And the combination of all of those things, I think, I'm not going to say that it shortchanges viewers. I don't think that would be a fair characterization. But there's no question that if somebody is going to delve into a topic with some depth and really try to work on improving people's understanding, conventional television, conventional media is probably not the source for that. Consider that, let's just talk about Fast Money really quickly. It'll give people an idea of what I mean. So Fast Money it's a post-market format show. There's a host, there's four regular panelists, and there's a host of guests over the course of the hour that show is on the air. They need to address everything from rates to equities to commodities, breaking news, economic releases, and all of those types of things. And they still need to have advertisements.
Right.
They still need to have teases, breaks, and so on. And when you think about it, there's 60 minutes there, but there's probably at least, well, maybe 10 people are going to speak at some point. There's probably going to be, 8 to 10 minutes of advertising anyway, plus breaks. And you do a little quick arithmetic and you realize, well, wait a minute. That means that every voice that's on probably speaks for a grand total of about 5 minutes in an hour.
Sure.
That's not a lot. And they're going to touch on a lot of different subjects. So it's great for a high-level view. It's suboptimal for a deep dive.
I agree. I think that's why you're seeing a lot of the long format podcast, even interviews, not financial related, they're really taking off. It really helps people get a better understanding than just the 10,000 foot view. So
yeah, 100%.
So in your new position, I'm gonna talk a little bit more about that in our next section, though. Are there restrictions that get placed on you as far as your own trading activity due to the fact that you are an influential person in the financial world? Like, is there anything like that?
So, there are different restrictions imposed by different entities. Let's put it like that. So, and I've now occupied so many different hats within the regulated space that those restrictions differ from one place to another. So, for example, when I was at Cantor, we had a pretty strict pre-approval process for any transactions in our personal accounts. And that's because I was pulling the trigger on a lot of trades each day myself. I was making markets in some securities. I was executing street side in others. And usually these were big block prints, right? So those are potentially market moving events. And it's a significant conflict of interest if traders who are moving big blocks of money around have the ability to move their own money around, maybe
Sure.
even their ability to move it around first, right? So
Right.
that wouldn't be good. And so it's common in the industry to restrict that, and that makes good sense. So on the sell side, commonly, everybody has a pre-approval. You actually have to submit an approval electronically. They're usually tied to your personal brokerage accounts. The compliance departments can see everything you have and everything you're doing all the time. And you can't even affect a transaction until your compliance department has approved it. Then it'll let the trade go through. Then, usually, most of the big institutions will restrict how long you have to hold that position. So if you change your mind, tough luck. In our case, it was 30 days. So you'd have to get pre-approval first, and then whatever you did, you were locked in for 30 days thereafter. And, the objective of that is just to avoid conflicts of interest. So that's important. As far as the news is concerned, they also impose a different type of restrictions, which is that they don't want people to go on the air and pump their own holdings, of course,
Sure.
or to say things that directly contradict what they're doing with their own money, but for their own benefit. There was a controversy a number of years ago. I'm not going to bother to mention the name. It was a very prominent fund manager, one of the largest, ran a big fund, and he was making recommendations on CNBC about stocks that he held. That, on its face, seems like a good idea, except that it turned out that he had owned those stocks for a long time and was starting to unload them. And by saying, look, I own all these stocks, I think they're great, if it ginned up support for them and he was able to then hit those bids,
Right.
Was it true that he owned them? Yes. Was it a little sketchy, let's say, that he was talking about it even as he was starting to offload those? Also, yes, for sure. So CNBC, rightfully, is very sensitive to those things, and so they ask for disclosures. Now, in our case, when I was at Cantor, when I was at CRT, and now with Title and YieldMax, disclosures are difficult because we have so many positions in so many securities that basically the disclaimer would be like, yeah, we're trading it because chances are we are.
Right. Okay, so that's tough because it's where do you find the happy medium? Because we're really handcuffing you and putting you at a personal disadvantage because a lot of these trades, especially you might be, I don't know if you use technical indicators or things like that. They're at a moment you might be taking advantage of something, and you might, you know, a little while later, my brother sent me a message the other day where he was in and out of a trade in 51 seconds and made $1,500. Like, you just don't have that ability.
Yeah, it's that's going to be difficult for us to do. I mean, I can tell you that the title traders are busy trading all day, every day. Um, Client investor money, and it's their fiduciary responsibility, mine too, to ensure that the investors get a good result. Now, the flip side of that is that I can buy some of our products, and then effectively our traders are handling that on my behalf. Would I rather be able to do whatever I want, whenever I want? Of course. I mean, nobody likes to be handcuffed in any way. But that's one of the trade-offs, and I'm willing to accept it. I think it's all right.
Sure. Yeah. So that pretty much answered my next question was related to that. Um, so realistically, you more have to make more long-term trading decisions, even though so much of your knowledge and background is options related, right?
Yeah, the exception to this would be broad market bets that, wouldn't have any, where there's no such thing really as inside information and there's no liquidity consideration. So, for example,
you're not going to move the S&P.
We're not restricted from trading SPX options,
right.
For example, right? You don't have to get prior approval for something like that, and that's true at most institutions. Like, if you want to trade an ETF like SPY or Qs, like a broad market index,
okay.
Directionally, you can generally do that without restriction. In fact, in many cases, the pre-approval system that I was talking about, what it would do is if you were putting that security in, it sort of automatically lets you go ahead and do it.
Okay.
But if it's a single stock or something a little narrower, where liquidity might be a consideration or information, could be idiosyncratic, you're more likely to see restrictions and things like that.
Okay, so that probably answers. I was going to ask you about, is it hard to kind of take off the hat as, chief strategist of YieldMax and put on, hey, I see an opportunity, I want to take advantage of this, but it doesn't seem like you're able to do that as far as in the day to day, other than big picture.
Yeah, I think, well, actually, the role of the strategist is more big picture. The traders are, these guys are very busy, right? So, gamma, which is the second derivative, so it basically is a monitor of an options delta relative to the underlying as the price of that underlying changes, means that if you're doing things like short-dated covered calls, you're probably adjusting those positions pretty rapidly when the stock starts to move. And and that's going on. So the strategist is typically going to have more of an overarching view. How does vol look? Should we think about, implementing strategies or even releasing strategies that take advantage of distortions that are going on in the volatility surface if the market conditions start to change? A lot of people who are, in YieldMax products or who follow the market, you may not be in any of our products, but you've probably observed that the volatility of Bitcoin, the implied volatility of Bitcoin, the volatility and implied volatility of MicroStrategy, now Strategy, has declined this year. And, there is a point at which, one might say, okay, well, what other things can we do to try to take advantage of what the options market is giving us at this moment in time? And that's sort of a broader question. You have to sort of take a step back from the day-to-day to evaluate those things. And obviously that's what Jay Pastorcelli and Scott Snyder and Mike Venuto are doing, at a very high level. But it's something I'm also very interested in, because I think it speaks to, how the strategies are doing and other strategies we might be doing.
Okay. Yeah, that kind of lead into, I wanted to start talking about your specific role as strategist, but just one last on this. Are you also on Blossom? Because I've heard Michael Venuto and Jay Pastorcelli say that they were. I'm personally not. I've just heard it come up a few times in different talks. Do you use Blossom at all?
I do not use Blossom, but I did just sign up.
Okay.
I only just recently became aware of it. And, it's interesting because, you mentioned at the outset that I was in Las Vegas last week at the Hood Summit. Mm-hmm. Robinhood started out as a financial social media business before they became really, an easy to use self-directed brokerage platform. And one of the things that Vlad, the CEO, was proud to announce this year, and he did when he made his keynote on the first night of the conference, was to mention that they're starting their own social media platform again. So they're basically going back to their roots, back to their original idea. They have some pretty novel things that they're doing with it, which I find very interesting, but it's real money. In other words, you follow pundits, you follow people. Now, in our case, those of us who are in the industry, not too hard to see who we are and what we do. We're obviously, anybody who wants to see what we're trading, what we're investing in, it's overnight transparency. Every single trade is there. So, but in other social media, people are following on, who knows what those folks are really doing. And that's what I thought was kind of novel about the Robinhood approach, is that apparently they're going to start tracking real money. So, there can be a lot of individual investors and traders who are remarkably good. It's people who are professionals don't have there's no monopoly on that. Right. So this is going to be able to sift wheat from chaff, I guess. It's kind of interesting.
I like that. Yeah, so I have Fidelity personally, and it's just me being, I think I'm even older than I look, but I just don't like change. So when I was watching you guys live trading to help explain things to people on Robinhood, I was like, that looks so much easier to use than what I'm using. But
Fidelity was my first too. I was in college. I opened my first options account at Fidelity in Boston. Drove down there with my roommate in college.
But I just don't feel like changing, so I don't know. But okay, so you talked about being the chief strategist, and my next question is related to that. So being in that position, so are you making sure the traders are sticking to the stated strategies, or is it your job to come up with new strategies, or a combination, all of the above? What's that look like?
So I'm not directing the traders personally. There's kind of a hierarchy of people that are doing that. At the sort of the top of the trading team is Scott Snyder, who probably some of your viewers are familiar with. He's participated on some spaces and possibly some YouTube videos. Maybe I haven't seen those, but there's and the other thing I think people should recognize is that these people, they're not living in a silo, going off into a cave someplace and people check in on them only, once in a while. This is a real-time thing. I mean, everybody at the firm who's involved with the investment process, I'm just going to pull it up right now, can see every trade that has happened during the day and every trade that's working. So, I cannot share this, of course, but I just pulled it up, and I can see everything that's working. I can see everything that is executed. There is every morning before the market opens, there is a trading team call where basically the prior trades were discussed. What's going to happen is also discussed, and just some sort of general process issues are also discussed. For example, Scott might say, I noticed that when you were rolling a certain position that you rolled here, why do we do that? Maybe we can do some things. So this is really monitored, I would say, in real time. It's not it's not a sort of ad hoc kind of a thing.
Okay.
We'll put it like that.
So I know is Scott specifically, pardon the lack of a better term, like the main guy for Misty, or is he kind of the main guy for trading in general? And then Misty
He's
just
kind of
happens.
like the main guy for trading in general, but he is also the main guy for Misty. So, obviously your viewers will be aware that we have a number of funds, over 50.
Oh, yes.
At this point. And, it makes sense to divide the underlyings, and allow certain traders to be responsible for those. Mm-hmm. And this was an issue even when I was a trader. I used to trade natural gas options, and we had more than one natural gas options trader. And when you have that, it can really create some issues. Now, at the time that I did that, this was when I was on the floor of the New York Mercantile Exchange. So I was in the options pit there, and um, I was trading something, and I had bought some calls in natural gas, and I sold some natural gas futures. Now, natural gas futures have a 10,000 multiplier, and I think I sold 100 of them, right? So that means that you multiply however much the price is changing in natural gas by a million. Now, that was to hedge my deltas. But meanwhile, another options trader that we had, he was on the other side of the ring. So we didn't know exactly what was going on. And we didn't necessarily everything in real time, because a lot of things traded in paper at that time. I have some trading tickets. I got them while I was in Las Vegas. I told a former Merc trader that I wished I had kept some, along with my trading jacket and other memorabilia that I didn't remember to bring with me because it didn't seem important at the time. I was just a kid. But he also was selling some futures. Now, as it turned out, between the two of us and the different things that were going on, we ended up short only a handful more futures than we meant to be. I want to say, maybe it was 4 or 5 futures, which in the grand scheme of things doesn't sound like much. Except natural gas managed to rally about $6 in the course of just over 20 minutes.
Of course.
Which is a huge move. First of all, $6. Natural gas isn't even close to $6 right now. But this happened within less than a half an hour, and our P&L just got slayed as a result of it. It was $250,000. It just got blown to smithereens because we were both in the same thing, trading our own options, and there was just a little bit of a miscommunication, and it had a big financial impact. So it's better, if you can, to have traders who are dedicated to certain underlying securities and really know, just like in a football team, everybody's got their job, right?
Mm-hmm.
You can't have people just deciding that they're going to willy-nilly take somebody else's slot. That's just not going to work. And so that's managed pretty carefully, and Scott's sort of at the top of that pyramid.
So when the underlyings that happen to have their own individual fund are also getting traded in these portfolio funds, or like the fund or the ultra funds, is it the same trader? Like let's say the person doing the trades for MSTR, if it happens to be in Ulti or LFGY at the time, is the same trader making those trades in Ulti and LFGY as they are, not the same, not choosing the same strikes, but is that the same trader?
So, one quick point I would make is that, one of the funds is basically just a fund of funds of the underlying ETF. So that's sort of a self-corrective mechanism.
YieldMax.
Ulti, I would quickly point out, is, it's not as straight as a forward as a buy right? So they have more flexibility. The way the docs are written, Ulti essentially has flexibility to do a host of different strategies. So that's a slightly different thing. And, for those reasons, you can have, and by the way, I also want to mention, it's not like there's only one trader who works on these things, but they focus on it in a given day.
Okay.
The reason that's important is because you can't have a situation where, and I'm not even sure how many traders we have. We have 2 pages. It seems like every day there's another, but, you also can't have a single person risk situation.
Sure.
You know what I mean?
Somebody's out sick, so MSTY is not trading
vacation,
today.
They get sick, stuff like that. So, but there is kind of a hierarchy, a waterfall, if you will, of how the responsibilities go. And if somebody is going to be out, or if somebody is out, there's sort of a natural progression to who, is going to take that role. But again, maybe the football analogy is arguably the most apt. You have a bunch of people there playing defense, and then you have safeties in the back. So, that's kind of how it works. There's a natural progression in strategy to the way the trading team operates to make sure that there's sufficient coverage.
Okay, thank you. So one more question before we get a little deeper into specifically Ulti. So do you, or maybe is anyone, is it their job where they're working with the brokerage firms or whatever to try and lower maintenance, margin maintenance on your products? Like I know maybe a couple of months ago, it was kind of a big announcement that Robinhood was lowering the margin maintenance on I think it was Misty and one other of your products. Is there somebody? Is that like an active role that somebody's trying to do with these brokers, or it's just they make their own decisions based on?
Yeah, so what you're referring to is going to be broker specific. You're talking specifically now about house margin requirements.
Mm-hmm.
And so, when we think about these things, there are regulatory margin requirements and then there are house margin requirements. And it's interesting because, of course, the regulatory requirements for margin also can change from one day to the next. You see that this more commonly in the futures market. If you take a look at, for example, the initial margin for a crude contract or something like that, it's based on the assessment of one-day risk to the position, to the underlying position for the holder of that position. And so as the volatility of the asset increases, the exchanges may increase the margin requirement. Well, brokers do something similar, which is that they make their own assessments about the risk associated with certain assets. And if they feel that the regulatory requirement is insufficient, they have the right to raise them. They can't lower them, of course, but they can raise them above the regulatory requirement if they think that's necessary. Now, some of those assessments might be based on characterizations that they have about, their user base. So, for example, let's just say that you started a new platform and it was tailored for people who have never traded before, that are in a certain income demographic, and have certain financial needs that they're going to have within a short period of time. So you can imagine that you have we have a self-directed brokerage platform for retirees with small accounts. Well, if you're aware that that's what your customer base looks like, that they are going to demand access to their funds, probably to support their life. That they are not financially sophisticated, and that their resources are limited. So things like big boy rules that essentially allow greater latitude wouldn't apply in that case. And that will vary from one platform to another. Some platforms cater to large, almost prosumer types of accounts, and they tend to give greater latitude. And the other is also regulatory capital reasons. So it is possible, based on the concentration of positions within a certain house, that they have to limit it. So, for example, if you're a self-directed broker and everybody on your platform is shorting GameStop during COVID, well, for your own survival, not just the survival of your customers, but they have to think about the firm, they have to think about their customers, and it's difficult for them. Of course, they're trying to look around corners. When things get choppy, you see, and we trade high beta stocks. I mean, let's be honest. Strategy is higher beta, right? Nvidia, somewhat higher beta, but a lot of these names are higher beta stocks, and if you have a lot of concentration in those, then the portfolios will too. So it's everybody's got a tough row to hoe of their own. We obviously would like to see more flexibility. In the same way I was talking about it before, nobody wants to be hamstrung, and we don't want to see anybody else. So if we, I guess, adhere to the ideas of classical liberalism, right? Everybody should largely be able to do what they want as long as it doesn't hurt anybody else. So I think they're doing the best they can.
Sure, but so it's no part of anyone's job is reaching out to a Schwab, a Fidelity, a Robinhood, and trying to get them to relax their margin. That's not something that's taken place from your guys' company. You just kind of let them.
Yeah, I mean, it's not our place. We are available to them to help them better understand the product.
Right.
Right. And of course, we try to promote the products, but it is not our job to try to promote a broker to make it easier to increase risk on their platform. That would be in the same way that they don't contact YieldMax and say, hey, we notice you're not using any leverage. Have you thought about rolling out some leverage strategies? I mean, they don't talk to us about that, and we don't give them too much advice on that. But we do try to provide transparency, and we're happy to have the conversation at any time about what we're doing, and why we're doing it. Because we think that the better they understand it, probably that's going to create greater latitude, not less.
That makes sense. Yeah, because I see some people say, "Hey, I'm getting out of you know." I know you like to use this too. XYZ. You can't really say that anymore because it's taken, but uh,
Yeah.
because they're making me use 100% margin, whereas this one allows me 25% or 50%. So, so okay, it's nice to get that question answered. So next, I'd like to transition more specifically. I'm more known for Ulti. I do cover a little bit of other stuff, but I dig real deep into Ulti. Um, so YieldMax seems to be popular among younger investors or those with a greater risk appetite, and just in general, like your older investor, my father or grandfather's um, age group, they kind of almost see it as something that that just sounds too good to be true. Just stay away from it. Do you think any part of bringing you on was in part to build confidence in those communities because they're the people who are more likely to have already known you as soon I was when it got announced, my dad instantly knew who you were. Oh, I know him. He's on CNBC. I watch him all the time. Do you think that is a part? I mean, obviously, not trying to just trick people into anything or just build like a false confidence, but just to help ease their minds that this isn't just a bunch of wild traders and you're gonna get burned kind of thing.
It might surprise you that actually I think it was the exact opposite. I think that they wanted me to come aboard specifically because not for the older demographic, but specifically to address questions that were coming from people who are in financial social media, finfluencers and things like this, where the really deep understanding of the underpinning strategies, what impacts them, weren't maybe that well understood. So there were frequently asked questions would be probably the politest way to say it. Misconceptions would be a less polite way to say it, I guess. And out and out inaccuracies and statements that are completely contrary to fact is the least favorable way to say it. But their idea was that there are some people who look at these things who clearly are missing some critical elements. I've spent a lot of my time in investor education and options trader education. In fact, back in my Bluefin days, that was one of the hats I wore there. I was actually responsible for the incoming trader trainee training classes. For one semester, I decided to move to a hedge fund after I did that. But it's obviously I wrote a book with Mark, who's now a professor at Rutgers, on these topics. They really, I think, thought of it more as being somebody who can serve as an educator for people who don't understand some of these things. And it wasn't and in formats like this, I don't think my parents are watching too many, YouTube videos about YieldMax or anything else. But, to your point, I think it's younger people that are looking at this. They tend to be, more curious, more willing to experiment, and they should, by the way. Younger investors have a lot more time to go.
Sure.
And I really encourage those people to, take an active role in their own futures. And the other important thing is that, they need to be and can be more aggressive than older investors are. If an older investor says, I just want to be in a fixed income portfolio, I can articulate that there are some flaws with that depending on their circumstances, but I'm not here to rock that boat, right? People need to be comfortable in their retirements. So
my dog
that's the first thing.
My dog wanted to say hi. He won't leave me alone.
I have a dog here too. She may or may not come in at any moment, but she's been known to do that.
So Ulti's been given a lot of flexibility and freedom. We've talked about that a lot, or maybe not you and I, but we've heard this in a lot of the different talks in the prospectus, that's a benefit to the traders and to us as investors. Is there a goal for future ETFs. Now, obviously, like your individuals can't necessarily enjoy some of the same freedoms, but is there a goal for any of the multi-stock funds or all the future funds to already get that built in now that you've kind of crossed that that hurdle with the regulators so that we moving forward? And is there also a goal to try and back up and give that to some of the other funds that are already out to just try and take the handcuffs off?
No, I think that's an excellent point. Well, first of all, that did happen with Alti. So I think it's important to recognize that in the early days, and we are actually still in the early days of options-based ETFs, relatively speaking, right? So options-based ETFs are quite new relative to my time in the market. I got into the options business in the mid-late 90s. What we see now was almost inconceivable back then. When you're in the early stages drafting some of these documents, it's a combination of options traders and investors and lawyers trying to figure out what to write for the regulators.
Right.
And I think there was a little bit of a learning curve there. And sometimes it's always impossible to forecast every single thing that might be implementable and advisable a priori until you've done it several times. Some of the single stock strategies are fairly restricted in what they do and what they can do, but that's by design. Mm-hmm. If I tell you, do you want to buy a covered call strategy in XYZ, ABC, it doesn't really matter. I can't suddenly pivot that strategy and say, okay, well, actually what we're going to do is buy puts.
Right.
Now, if, within the YieldMax context, the whole idea, as the name implies, is to maximize the yield. So they're likely to be short options trades in general. But when you start dealing with multiple underlyings and you have additional flexibility with the way you can do it, then you obviously have to have documents that support that suitable flexibility. So Alti and Salty have that. I would imagine on the single stock side that the answer to that is probably not, right. Which is to say that, the Reddit product, which just came out, it's not going to necessarily have the kind of flexibility that a Salty or an Alti would,
sure.
Right? Because it's kind of, you need the strategy to adhere to what's on the tin.
Right.
No. The other thing I would say is that once you have a product that has suitable degrees of flexibility, how many more new ones do you need, right? So Alti can trade multiple underlying securities and it can do multiple things. For people who want the manager to have more flexibility and to have that automatic diversification and to take the stock selection process out of it, that's probably a good strategy for an investor like that who's interested in YieldMax products, and they can deploy to that, and that money will be put to work. So, if you think of the best investors in the world, if you went to Warren Buffett and said, okay, well, do you need to have, instead of Berkshire, we're going to have some other company and another and another. If you want to have access to that process, the vehicle's there. So I don't know that we need to have too many single stock strategies that have catch as catch can kinds of strategies.
Right.
So
makes sense. Yeah. Warren Buffett.
Long-winded answer, but
yeah,
that's okay. Helpful.
Yeah. Warren will probably just say, I'll just buy those other ones when they get big enough.
Right.
So Alti and Salty, they both say they select about 15 to 30 underlyings, right? And they trade off of them. Is there an effort to make a certain portion or percentage of those, I call them core holdings, ones that are in there long term, versus a percentage that is, say, just an earnings play or just a short term? Is there anything like that or no?
Well, one of the things you hit on something important, which is that for a YieldMax strategy generally, the volatility, or perhaps more accurately, the expected volatility, the implied volatility of the underlying instrument is going to be an important factor. And that can rise and fall So that's going to have an impact. Alti has a more bullish tilt and Salty a more bearish one. And that too is going to naturally cause some turnover in the underlying names, because the view on those underlying names will change through time. And the potential catalyst that they're going to be subject to in the near-term future is also going to change. My expectation, Salty is a new product. It's only been out for a relatively short while. My expectation is that there will be less core names in that. I don't know that that's true, but that's my expectation. This is just based on being, a long-time market participant.
Right.
And what I mean by that is, if you have a good company that you're invested in on the long side,
you're going to stay in.
Until things change materially, there is not much reason to change your view on the stock. It's one of the reasons that some passive strategies can do fairly well over time, because they buy something and hang on to it, for a long time and allow that to grow. A lot of traders, a lot of investors take their profits too early. There have been a lot of times over the course of the last 10, 15 years that somebody who had chosen NVIDIA might have elected to sell it, but the broad indices haven't done. On the short side, though, it's a little bit different because, your thesis could prove correct, in which case the stock declines. Maybe it goes out of business, right? So if you had bet against Enron, or if you bet against a Signature Bank or one of these, there's a lot of things, Silicon Valley Bank, there's a lot of things that you could have bet against. If you were right, they're out because you were right.
Sure.
And if you're wrong, you're also out because it's
hurts
probably not a great short. You cannot. There is no equivalent to, the Mag 7 or even the Mag 10 on the short side, where you could have bought them 20 years ago and hung on, and it'd all be good.
Because they'd be gone by now.
Yeah, they either were gone or they took your head off.
Okay.
So I'm always impressed by people who are short sellers, and live a long time in the investment world, like Jim Chanos. It's a very tough game. I'm not a huge short seller myself, so I'm, when people are looking at Salty, I'm glad it's not my job to pick shorts, because
okay.
that scares the heck out of me.
That's good to know. So we've heard. I don't know if it was Jay or Scott help us to understand when they are rolling their call spreads on the individuals, right? So they've got a short call, and then a lot of times a long call, kind of backing it up. And they've explained that, let's say the share price is blown through their strike, and people are wondering, well, how come they closed this one, or why didn't they close that one? And they kind of explain that it's a fairly easy math problem, and it's just when the value of the long call reaches the extrinsic value on the short call, that's when they're going to close it out. Am I right on that so far?
Yeah, I mean, here's an important thing to think about, right? So I think here's one way to think about it. These strategies are looking to harvest yield by selling options premium.
Sure.
And why don't I come up with a really sort of generic, basic example? We have a stock. We can choose whatever letters we want for it, but we will call it stock ABCD, Abracadabra Company for now. So Abracadabra is trading $100, and it has weekly options. And to collect some premium, I sell, the 105, 110 call spread that expires the following week. And I sell that call spread for $2. So 40% of the distance between the strikes, right? Now, if the stock does nothing between now and expiration, I'm going to make the $2, right? Or even if the stock runs up to my short strike, up to 105. I mean, the most I could potentially make is, if I'm long the stock, in this case, we'll assume we're not. We're just short the call spread.
Okay.
But I'm going to make the $2. Now, if the stock runs to 110 instantly, let's say that I timed this trade as poorly as I possibly could have.
Mm-hmm.
I sell the 105, 110, and then literally, as the trade is executed, it comes up on the wire. Abracadabra has been added to the S&P 500. and the stock's up 10%. It's now trading 110. Well, what's the value of that call spread now? Does it instantly go to $5 if it has a week to go? Well, the answer to that is no, it does not. It will be worth $5 if that trade is held all the way until it expires.
Sure.
But it is not worth $5 at that moment. So if I'm short that call spread, I have an interesting conundrum. And that is that if I hold this position, which I sold for 2, and maybe now it's worth 375 or so, maybe close to 4, do I stay in this position or do I adjust it and roll up? Well, if part of my objective, my investment strategy, my thesis is that I'm trying to collect premium, this no longer has positive decay. I'm not getting paid each day as time passes, because as time passes, it's going to converge to its intrinsic value, that intrinsic value now being potentially $5. So, the traders have to contend with the fact that a positive yielding trade can, in that circumstance, turn negative. Now, if let's say I'm in a strategy where I'm in condors, right? So Ulti can do condors.
Yeah, they just did one last week on First Solar.
Yeah, that's exactly right. One of the reasons I mentioned it, there was a condor in Ulti last week. So the interesting thing about this is, because of stock, we're not living in the quantum world when we're dealing with stocks, meaning that a stock price cannot be in two places at the same time. Right. So if I'm short a call spread and I'm short a put spread, it could be between the call spread and the put spread, or it could be through the put spread short strike, or it could be through the call spread, but it can't be both.
Right.
The interesting thing about that is that as the stock price rises, that put spread is decaying in value, even as the call spread may or may not be appreciating in value. And so these adjustments become a little bit easier to manage, because the other dilemma the trader has to face is this a short-term move or is this an immediate one? I've also lived through the flash crash. If you were short put spreads in the flash crash and you were observing it from my seat, it was very clearly some kind of a strange, idiosyncratic moment. We looked at this and said, something's wrong. This stocks are not behaving correctly. Either an algorithm went wrong somewhere, something is off. And we knew that. And if you're in that situation, we were trying to debate, do we buy futures here? I actually did try to buy some during the flash crash, but I was using limit orders because the prices were swinging around so violently. But if you were short put spreads, at one point you could have been short a put spread, and all of a sudden the underlying has blown all the way through it. We saw $60 stocks print for $1, right? Well, what do you do then? Well, traders have some discretion. In that case, I would say I'm not doing a thing, because something's not right. And it's a really bad idea to start having a knee-jerk reaction when you know something's off, right? You don't just start, you start seeing funky things going on in your display panel in the cockpit of the plane you're flying. You don't immediately start violently putting control inputs in. That's probably not going to be the answer. It might be in some cases, but that's where discretion is going to play a little bit of a role. So, I think there's a combination of answers in there. I hope it's helpful. But one of the things is that if you're trying to, continue to collect yield, strategies that were positive theta, collecting decay, can turn the other way, vertical spreads in particular. And you may, want to make adjustments to handle that, just so that you're continuing to meet your investment mandate.
So trying to relate that back to Ulti, where a lot of times it's not a spread, it is just a short call. It's a collar most of the time, right? A short call with a long put. Still kind of the same answer though, as far as when you're going to roll those calls where the strike has been blown through.
So it's interesting because a collared, there is a bit of a parallel in a collared stock position and a vertical spread, but in that case, you're actually long the call spread synthetically, right? So if I'm long a put and long stock, that's a synthetic long call. That's going to be out of the money to the downside, and short and upside call. So if the stock rises, time is always going to be on my side, or it has no impact.
Okay.
Right. So what's the reason for this? Because the maximum value of the position can only be effectively the difference between the strikes, right? And that value will be achieved if and as the underlying asset gets to the higher strike option,
Right.
that short call.
Sure.
So if it's at that short call or higher, there's no circumstance where I'm now going to start to lose money as time passes, right?
Okay.
So if I'm short a call, an out of the money call spread and the stock runs through, now a positive theta position can become a negative theta position. But if I'm long the stock and short the upside call, regardless of what's going on with my downside put, this is now a situation where, in the worst case, I've made all the money I can possibly make. So that's an important, I think, an important difference.
Okay, yeah, that makes sense, because basically what you're saying is now the expense to close out that short call is only going to diminish as time goes by. If the stock were to stay the same, but either way, if it stays the same or goes higher, the value of your shares is staying the same or going higher. So there is no losing on it. So that makes sense. All
exactly. Right. You've hit on it precisely. So it is. You can think about this, that the value of your position is going to be the maximum, or I should say this, the value of your position is going to change, assuming the stock does not fall, is going to be the maximum of 0 or some number greater than 0.
Okay.
So it's not going to deteriorate on you from that point forward. Now, they will adjust call positions because they might be making that exact assessment. They're going to say, we've made as much as we're going to make. Why not roll this thing and try to milk a little bit more out of it? And they can and will do that.
So in this same sense or topic, are you able to explain to us kind of what goes into the thought process on where to select the long put strike as far as the collars in Ulti?
Well, one of the important elements, of course, is that these are supposed to have positive yield, right? So functionally, that's going to create some limitations on where your hedges are applied. For an example of this would be, wouldn't it be nice if I could buy a stock, buy an at-the-money put, sell an out-of-the-money call, and have positive yield?
Doesn't exist.
Well, of course that would be nice. That's a functional arbitrage. I can't lose.
Right.
I can only make. Such a trade does not exist, or it should not exist. And if it does, in the real world,
if it does, the pros will catch it quick.
So really, what's going on here is they are looking to see what is the best hedge I can afford given my yield targets, right?
Okay.
So when you're looking at, anybody could do this, right? You could sit there and say, okay, well, I'm going to buy SPY and I'm going to sell some calls against it, but I want to have a disaster protection in here, so I'm going to buy some downside puts. Well, if yield is part of your objective, now if you own the underlying shares, it's fair to incorporate some of the dividends you might expect to receive as a portion of the yield, right? It's going to be de minimis. I mean, SPY's dividend yield is, very few people are going to be able to live on that. But, you can do that as a part of your calculus, and then you can sell an upside call, and then you say, what is essentially the minimum yield I'm willing to accept between now and the expiration of my short call option? And if the value of that call option exceeds that amount, then I can go and identify puts that I can purchase with essentially my excess, if you will.
Makes sense.
So, and look, I think people can do these kinds of things very reasonably. I would actually say, for those who are playing along at home and say, hey, I want to experiment with my own options trading, and for those that have the time and resources, I encourage that, because only by doing these things will you understand these processes better. Sometimes you might say to yourself, well, where indexes are concerned, they tend to have a lot of put skew. Maybe I'm just going to buy a cheap out of the money put spread. You can do that. I mean, they're less as prevalent now, but before I can remember, it was probably January, before we knew the pandemic was coming, or suspected it, but it hadn't yet. And I remember this distinctly because I was actually skiing. I had gone to New York for the show and flew to Salt Lake City and was in Park City. And I looked and I said, hey, there's some SPX put spreads. I can have these things as tail hedges, and they pay like 8-1. So pretty small. And I just said, if they start shutting things down here the way they are in China, and at that point it was Italy. I don't know if you remember, but now we're into February, and I think it was February or March, but it was right around that time. And Italy was one of the first sort of Western countries to be severely affected. Buying puts by itself was very expensive, but as a tail hedge, you could buy cash settled, tight put spreads that had big payoffs, and it didn't cost very much. So you could sell upside calls and then buy a couple of these sort of binaries, if you know what I mean. And so I encourage people to look at this, because if you do that, you're going to understand, the options market better, and you're going to understand what YieldMax is doing better too.
Right. No, I agree. I learned more from experience than I do from anything else. I mean, there's
a painful one.
Definitely things to be said. Yeah, right. This talk doesn't hurt nearly as bad as losing $1,000, and you remember the lesson from losing $1,000 forever. So, and just a note on that before I go to the next question, I do like what you guys have been doing lately, because it seems on Ulti, right? Because you do have a positive tilt on these. So where we are buying the downside protection, but realistically, sometimes we're looking at them. Do we need full downside protection? We don't think this is going to zero. So how about we then sell puts even further out of the money just to help pay for those insurance policies? So I really like that. Not that it matters whether I like what you guys are doing, but
no, I mean, this is a really important point, because even if you don't get, I've seen some market crashes in my time. I was in the business in the tech wreck. I was in the business in the great financial crisis, and several other instances have come along. And you rarely can find the perfect hedge, and most of the time hedges expire worthless, right? Mm-hmm. So it would be very expensive to get really powerful hedges. The real objective is to decide, just like you do with your car insurance, how much of a deductible am I going to deal with here? And by using things like put spreads, going a little further out of the money, you can usually get the disaster protection you need without spending too much. I mean, I'm sure that if I called Progressive and said, and I've got 2 teenagers, I mean, so it's just a complete disaster when it comes to car insurance. And if I said, hey, what should I have? I'm sure they've got a lot of great suggestions for me that are going to cost a ton. But I run a $2,500 deductible on all my cars, because these kids, and then I'm just going to have to figure out how to fix it myself when that happens, because otherwise my insurance was going to be, I think, what did they tell me? It's going to be like $900 a month. And I just said, yeah, that's ridiculous. I'll self-insure.
Sure.
Thanks.
Yeah.
I mean, if I can cut that in half, and I'll just set that money aside, and I'm like, there's my deductible. Sure. And I'll get that working for me. My deductible, I'm not going to give all my money to you guys and have it go into your investment portfolio. I'll keep it and take my chances.
I like it.
And, one of my kids has been driving for 18 months, so that trade has already worked out. So there's a certain amount of risk we need to be able to wear ourselves. And I think that's an important thing too.
Sure. I like the way you look at that. So here we talked about this a little bit before we went on here the other day when we talked. Do you think, how are you on time, by the way? I don't want to put you.
Yeah, no, I have another call in a little bit, but it is not at the top of the hour. So let's okay. Try to work our way through a few more.
So I've heard you talk about it on a Spaces, and it really kind of helps people better understand this total return on Ulti. And we talked about, since you kind of have the ability to, can you actually show us Ulti's total return versus the S&P, so people can see that this is not just a chart where you just look at the chart and go, oh, Ulti's not for me. Not that I'm not trying to talk anyone into buying anything. It seems like a lot of people on social media want to come in and argue like, hey, I'm providing information for a very popular fund. I'm not trying. If you don't like it, I don't want you to invest in it. But
Yeah.
But we want to
Yeah, so
clarify.
I think I can do a screen share. I'm just going to make sure that my trading screens are turned off.
Just in
So
case.
I do not accidentally share things I am
Sure.
100% not able or permitted to do.
Yeah,
Um,
let me pull up my
but
trading
yeah, so
account just in
I'm gonna
case you
have
do.
on one screen. What I'm gonna do is we'll just take a look at the results year to date, right? So from December 31st of last year, and let me see where I can. I have a number of screens here. Just need to make sure. Let's see, where is the. Here's the share button. Perfect. And hopefully I'm sharing a screen now.
Yep, I can see it on my end.
Okay, perfect. All right. So let me just explain quickly what it is that we're looking at here. And I think this is where a number of people who are less familiar with the concepts of total return go a little wrong, right? So I'm going to highlight one section here. I'm just going to grab it with my hand. That's the white line. That is the price of Alti since December 31st. And if you looked at that chart alone, you would probably say, well, that doesn't look like a great chart. In fact, I could put that on another one here. Again, we'll just make sure that we're going like for like. So I'll just go year to date. All right. So you look at that chart and you say, well, that doesn't look so great because the price has been going down. It doesn't seem to be if you were a technician, you'd say, does that look like that's in a good trend? But the thing is, when you're dealing with assets that pay distributions, big distributions, and regularly, you must look at them on a total return basis, because this would essentially be the chart that you would look at for any amortized debt instrument, right? Because, the principal might be declining, but the return of principal and interest might be extremely attractive. And in fact, that's the case here. So if we compare, that is what is in this orange line here. So white is the price, orange is the total return, and these little blue dots over here are every distribution. Now, in Alti's case, as you know, it went from monthly to weekly.
Yes.
So you can see that the distributions became far more frequent. But this number over here is the total return for the year, right? If you had reinvested back into the security. And that is 16.6% since December 31st. Compare that instead with the S&P 500. If you had, again, like for like, bought the shares and reinvested the dividend, your returns are 13.4%. So Alti is outperforming the S&P on a total return basis. Now, I'm not meaning to imply that that's always the case, that every options-based strategy will always outperform the underlying assets. That would be ridiculous for me to say that. That's not true, but it is important to recognize that it's not underperforming it. In fact, it's performing quite well. I think most people would say this is the annualized rate of return for Alti right here, right? Mm-hmm. So buy the shares, reinvest the dividends. You're on track at the moment, an annualized rate of return of 24.24% versus 19.45 for the S&P. Again, assuming you're reinvesting the dividends. You don't have to reinvest the dividends. You could invest the dividends in something else, like treasuries. That's going to lower your yield. This is assuming you're reinvesting. This is an average risk-free rate. So I can put anything I want in here. I could say, if you have a 5% CD, I could say, okay, well, what would it be if it was 5% CD? So this is a number that's just a little calculator that Bloomberg offers, so I can just manipulate that number. But, the fairest like-for-like comparison that an investor can do is to say, if I buy an asset and then reinvest any distributions I get from that asset in the asset, how does that compare to other instruments if I did the exact same thing? And that's a fairer way to think about it.
I like that.
When you look at it in this way, it's going to look. It looks very, very different.
Yeah, I'd like to also point out, just in case people think that you're cherry picking there, that you've actually picked a scenario that's not putting Alti in its best light, because Alti changed their strategy back in the March-April timeframe. So they actually
Yeah,
they
no, that's
changed
right.
they changed the strategy in the previous year in the prospectus, but they actually put it in play in the March April timeframe. A lot of people think it's
Yeah, that's when we also went to week. That's
went to
also when
weekly.
we went to weekly distributions. If I decided instead that, okay, well, why don't we take a look at it once we went to the weekly distributions, or let's just say I said, okay, maybe the way I want to do this is I want to go to, um, the 1st of March, right? Oops, 2025 is not a valid. Anyway, there we are.
Right, you're not cherry picking when you do this because
No,
Ulti's chart looks
the year
even
to date.
better once they
It was a
change the
year to date
strategy.
chart. I don't. I one of the things I like to do is sometimes pick the worst performing periods and say
Sure.
let's talk about those first. But let's do the same thing now from the 1st of March, or something like that. And you can sort of see how it compares. So it's 11.84 here versus 20.8
Right.
for Alti.
But
Right.
you
But
showed
I mean,
that
it would not have been. I take. We take the good with the bad, or
right.
more accurately, I guess I'm saying I take the bad with the good. I'm not trying to slice and dice and say, well, if you look at this little window, you can see we really crushed it. I mean,
Yep.
what's a very common way for people to think about an investment during the year? How did we do since the beginning of the year?
Yep.
It's like the most natural. It's actually a default. If you
Yep.
look right here in Bloomberg, you can choose a month, 3, a year, or year to date. Most people like to look at the year to date numbers.
Yep.
So
Yeah. I just wanted to make sure people didn't think that it just happened to work out that way because in fact the share
Yeah,
price.
no, the outperformance has been higher lately. That's true. But
Yep,
like I said, I mean, there's no, this is, again, I don't want to cherry pick. I
right.
want to explain how people should think about an investment, whether it's outperforming or it's underperforming. Just make sure you look at a total return. Because otherwise it would be like looking at can you imagine if every bank looked at every mortgage that they gave and said, well, the principal's going down, these things are terrible. Well, never mind all the payments we got over the last 20 years, but
yeah.
there's no principal left. That was the whole idea. You loaned your money out, you got it back, and you got interest.
Yep.
Great. That's what you want.
All right, so thank you for showing that. And again, I want people to see that you actually didn't put your best foot forward, best time period forward. You actually showed, a standard time period that would actually make the chart look worse. And in fact, changes have been made and have taken care of that drop that was happening, putting in these protective puts that we have been very appreciative for. So I'd like to kind of switch to some maybe some less in-depth questions to kind of lead us to finishing out. So we've seen some back and forth a little bit lately on some social media platforms between, I think it was it a Round Hill thing or a Granite Shares thing? But is there a sense of competition between you guys? Is this kind of all just in good fun, or is there anything in like, we want to beat them? Say if we have a like for like fund for them, we're trying to beat them, or is that, hey, we're so focused on trading that we don't care what they're doing?
We always care about what everybody else is up to just as much as anybody in any business does. If we were all playing exactly the same game, then you can only imagine that competitive spirit would be fired up even that much more.
Sure.
YieldMax has a slightly different strategy, obviously, than the Round Hill guys do. They're employing leverage.
Right.
We don't. So that's going to create a different return profile.
Yeah. But maybe say a SDTY compared to an XDTE, right? Your guys' 0 DTE on the S&P versus theirs. That was as close to a like for like as you're gonna get.
Yeah.
Are you trying to beat them there?
Yeah, I think it's fair to say.
Good. I like it. It.
Am I going to say that that on the trading calls that or that everybody's saying, oh, how are they doing, and nobody pays any attention? People are paying attention.
Okay.
Of course they are. And this is healthy, right? It's healthy for us. It's healthy for them. there are differences of opinion sometimes that arise about how a strategy is implemented in those instances where we do have mild differences. As you point out, there's some products that are more like for like. But yeah, we do care. And investors should be glad that we care.
Sure.
Right? The best thing that can happen for investors is that we are all out here doing the best that we can and trying to beat one another. Because what does beating one another mean? That means we're giving investors more than the other guy.
Right.
And if everybody's always trying to do that, that means that everyone's going to try to be at the top of their game. And that's the best thing that can happen. That's what a free market is. And that's why it's, one of the better systems yet devised. So, yeah.
Good. I like it.
Am I going to say that people are possessed by it? It's the only thing they think about it. On the weekends, they're railing, to their significant other. Can you believe what those guys did?
No.
I don't know, but we're looking.
Okay, cool. So, speaking to those differences, this one kind of surprises me. You guys have raised the bar on transparency, right? As far as you guys are talking to everybody on shows. You've got your Spaces Talk with Wolf Financial every Wednesday, where the average Joe can just come up and ask you a question and you're going to answer it right there. You share your trades daily on everything. The other ones aren't doing that. Do you know why they haven't? Because, you guys, it's almost like you're pulling away. Everyone sees it and they're not following your lead and they're just letting you pull away. Why do you think that they're not following up with this transparency?
In fairness, look, there are managers who do try to play things closer to the vest. Mm-hmm. Sometimes you can have valid reasons for doing that. When I was on the hedge fund side, one of the things we did not like to do was disclose what we were up to. We didn't want anybody to be able to see it, not until it was done.
Right.
In these when you have investments like these, though, that are more structured in the nature of their strategy and where the instruments are maybe not as familiar to investors, I think transparency is really important. People can, say whatever it is that they want to say, but if you are completely peeling back the kimono, it's not necessary for us to dismantle faulty arguments about what's going on in there. So that's the reason why transparency can be good. What are some of the reasons why transparency is, from a manager's perspective, might not be so good? Well, one, it's more work, right? Mm-hmm. It means there has to be somebody who's available to do YouTube videos like this one. It means that, you're disseminating that information every single day for all of your funds. You're uploading it to your custodian. You're getting it out to the website. These things have to then be reconciled. It's not free in terms of time and resource to be completely transparent. We think it's important. Others may not. There's a regulatory requirement for transparency in ETFs, which is generally good. It's uncommon for most ETFs to have significantly less transparency. So for an ETF to have transparency like a hedge fund does, or a private equity firm or something like that, would be unusual. The amount of transparency we have is obviously greater because we try to make ourselves available and we reveal the trades. And I think the trades are probably the most interesting part, because what it does is it permits people who, if they wanted to get into the weeds, say, oh, wait a minute, okay, they had this, and then they did that to get there. Then you can reconcile that against the shares outstanding. Creations, redemptions would be one reason for a trade. But once you net that out, you can really get a better insight into how the traders and investment managers are managing your money.
Right.
And I think that's important. It still leaves a lot for investors. It. If you're going to look at these things every day and try to figure it out, there's still some work to be done. But I like transparency. It's one of the features of ETFs that makes them attractive. And I think the more the better generally.
I think it's been beneficial for you guys. I don't remember the exact number. I think it said you're managing around $42 billion right now, whereas one of the other ones that we mentioned just announced that they are at $7 billion. So I think that if in this, say, category, this high yield income ETF category, if people are going to call it take that risk, they're going to want to see what their money's doing. And I've literally had the other companies reach out to me and say, hey, can you start covering our funds? And I say, can you start providing your trades? How do I cover your funds if you don't show your trades? And they said, no. Okay. Then no, I have
Well,
nothing to talk
yeah, I
about.
mean, within the title group, so just on the AUM portion, within the title group, generally, I believe, yeah, I mean, I think you're right. It's in the mid 40s somewhere. YieldMax is closer to 20 because it's about half of the total assets. So of all of the funds that are managed within the title, and there's other income strategies, sort of within that umbrella, other than the YieldMax ETFs. But the YieldMax ETFs, I think, are closer to 20. So you're saying our competitors just announced they got to 7, over 6 was the last I heard. But yeah, we got to get back in there and start working those hamster wheels a little harder, I guess.
All right, so that's pretty much everything for my questions. This next one's going to be the easiest one of all. Right, my dad was really excited when he heard you were added to the team. Like I said, we were visiting him. We were on vacation at the beach together. We watched your first interview together. So could you just say hi to Danny for me? He'll be watching.
Well, Danny, I've really enjoyed talking to your son, and I'm glad that you've watched CNBC and watched the show over all of these years. And I'm glad you're watching us now. And what your son's doing actually in many ways is more important than what we did on CNBC, because it gives those of us who are in the business an opportunity to interact with all of those who are using the investment products and services of the business. And I think that's informative for us, and hopefully it's informative for you too. And I really enjoyed talking here to the inspector. And yeah. Of course, I'm happy to talk to you, Dan, anytime you like as well.
Thank you. So do you have anything that you want to plug, like your YouTube podcast, anything that you're working on that you want to?
Oh, I mean, I don't need to plug it, I guess. I mean, it's I do have a YouTube channel called Open Interest.
Mm-hmm.
If you go to openinterest.pro /live, I generally try to get 2 live streams a week. And it's just, we call it open mic, and it's just, again, more open kimono type stuff. I'll just share a couple of my thoughts, and then it's nothing but questions. People can ask questions in real time, and I try to answer them. I certainly don't have all the answers, wish I did, but if and when and where I have some thoughts about it, I'm happy to share.
Okay, thank you. All right, and then the last thing, on my channel, I like to end my my videos with a dad joke. I'm a dad. I know you're a dad too. So do you have a dad joke, a favorite dad joke, or one that you could tell us, or am I putting you too on the spot?
Well, I'm losing my hair. You can't really tell when you look at the front, but I'm losing my hair, and I have 2 teenagers, and my teenagers are forever. They're always hitting me up on instant message, asking me for some money on Apple Cash, and I can tell you how you lose the hair. My son will reach out to me and say, "Hey, Dad, can you send me $20?" And I'll always respond, $10. What the hell you need $5 for?
I like it. I'm gonna have to use that. I have 3 daughters, so I'll be getting hit up for lots of money. I already do by the oldest, but no, that's a good one. I'm using that. So, all right, well, sir, it was very nice talking with you. I really appreciate you doing this for my channel and for the viewers. So,
well, thank you for doing it. I enjoyed our conversation. I hope we get to do it again soon.
Same here. All right. Thank you. Have a good day.
Cheers.